if you're not a loan officer or mortgage broker, you should probably swipe up because this is going to be kind of a detailed, boring video, so to speak, but it's really exciting for those that actually need this information. And we're going to talk about making exceptions on loans because at the end of the day, a lot of times you're going to come across some clients that don't fit into certain guidelines, but it's so close and there's other recognized compensating factors that are going to help outweigh whatever additional risk you're going to have on that file. For example, you need to go 80% loan to value on a property, but really because of the FICO score being at a certain number, you're only going to be able to get 75%. Well, to get that extra 5%, why should we make that exception? I'm going to read you a list of these recognized compensating factors because they're extremely important in structuring files that still make sense for lenders where the exceptions can be made. Number one, debt to income ratio below program maximum thresholds. So if this person makes a lot of money and their debt is relatively low, and that ratio of how much they make to how much their debts are is really low, that could be a compensating factor. Significant residual income remaining after all debt service. So if this person is an investor and they have rental properties and they have this passive income coming in, and there's a lot of it after all the debt and the mortgage payments, property tax, insurance are paid, then that's going to be a compensating factor. Steady employment history demonstrating strong income growth. You guys, if this person has been in their line of work for only 1 year, that's not very helpful for the file. But if they've been working in the same line of work or have had the same business for 20 years, that's a compensating factor. Excellent property collateral with strong appraisal support. Right now in a down market, more than ever, you need to focus on collateral. And if this is like a turnkey, beautiful property, amazing location, well then, hey, guess what? That's going to be looked at positively by the lender. Could be a compensating factor. Loan to value substantially lower than program limits. So again, if you have a lot of equity in the property or there's going to be a large down payment if it's a purchase, then that's a compensating factor because if the bank has to take back the property, there's a significant amount of equity to be able to get their loan repaid. Okay, meaningful cash flow down payment from borrower's personal funds. That again, I'm sorry, cash down payment. So if the borrower, your client, is putting a significant down payment, then they have a lot of vested interest inside of that property, and they're very likely to continue making those payments even if things get difficult and they have hardships. Strong credit profile reflecting responsible credit management. You guys, if they have excellent credit, I mean 800 perfect credit, that shows a history that can be used as a compensating factor because the biggest predictor of the future is the past. Okay, and then extended property ownership demonstrating stability and low default risk. We have these clients that have a substantial real estate portfolio. So if this person owns 20, 30 properties or more than 5 or something like that, and they have no mortgage rates on any of those properties and they've owned them for X amount of years, that's a compensating factor. And then previous credit challenges offset by demonstrating reform and supporting expectation, supporting explanation. So if your client has a credit issue, has a mortgage late, has a bankruptcy, has something, but they have completely rebounded from that life event and they've rebuilt their credit and they've been rock solid since that thing happened, then that could be used as a compensating factor. Consistent employment history establishing income stability and growth potential. Similar to the one before, where it's just been consistent over time. They've had the same income, they've had the same deposits, they're not declining in income, they're really just steady and very consistent. That's positive. And lastly, substantial liquid reserves exceeding minimum program requirements. So if this person has $1 million inside of their 401k plan or some type of significant amount of liquidity, some money they have access to, they're more willing to make exceptions here if we see some of these compensating factors. So anyways, you guys, I know it's kind of boring, a little bit long-winded, but I wanted to share this with you because it's extremely important when you're looking at files that don't fit certain guidelines, but you still believe in the file. If you have any questions, let me know. Hit me up in the DMs. And also, you guys, non-QM wholesale lender. That's why I am. I live and breathe these type of files, bank statements, DSCR, ITIN. All of these type of loans are something I can help you with. If you're either doing it already, let me add to your lender lineup. And if you're not doing that, let me show you how you can close more deals, and help more clients. Let's go.